What's up guys, welcome back to another video. In this one I'll be discussing a dynamic trading strategy that I used in one of my recent trades. If you are interested in learning, I recommend watching this video in its entirety. Now, the way how I approached this entry was by closely monitoring and adapting to changing market sentiment. I began by identifying momentum, which allowed me to spot a distinct 5-minute time frame trend in the market. Once I identified these upward moves, I started to look for key technical indicators such as accumulation or distribution stages and obviously other technical elements to determine not only my point of interest but also the best entry and exit points possible for the trade. With these essential components in place, which confirmed to me the high probability aspect of the trade, I proceeded to pull the trigger on the long side of the market. But let me take a moment here to explain to you in a more detailed way my thinking behind the 5 steps I took that led to this scalp. As I mentioned, I found momentum at the 5-minute chart as the first step of this dynamic trading strategy. So after this approximately 11-point spiking demand bar, the market went through a decent accumulation phase. Obviously this was followed by 2 more accumulation stages, one obviously at a higher price point here and another at the 44.78 level. And now the price action that emerged from these accumulation phases is a crucial component of this entry, bias-wise obviously. That's why I think it's worth taking a closer look at this trading range. So again, these sideways movements, which mark the second step behind this trade thought process. So these sideways movements signal, in my view, a potential price increase. And this is because during each accumulation phase, higher lows have been created, indicating a growing positive sentiment in the market. Market sentiment, as you already know, is an important factor that affects market direction or market bias, meaning in this case, traders generally believe the market will perform well. In other words, as buying interest continues to rise, the market becomes increasingly prepared for more upside, enhancing this way the likelihood of higher prints. It's also important to note here that the formation of higher lows during accumulation phases is not just unique to this particular trade scenario of mine, but is actually a tried and tested pattern that I have observed across various markets, particularly in futures trading, with I think a decent to high rate of success. And as I've said before, guys, trading is not an exact science. However, if you take the time to analyze historical data, you will find that accumulation phases often lead to significant price movements as smart money and other financial interests in the market attempt to manipulate it and its direction to their benefit. Therefore, by using price action analysis to identify such patterns, day traders like us can make informed entries that may lead to profitable trades. Now, moving to step number 3, this step was another important element that provided me with valuable insight into the macro structure of this scalping trade. And by macro structure of the trade, I'm referring again to the broader market sentiment as well as market conditions that can impact the outcome of a trade. Said differently, macro structuring is a part of technical analysis that provides us context and perspective on the market's overall trend and bias. And bias is obviously key when it comes to identifying high probability trades with greater accuracy. So upon analyzing the 5-minute chart, it is evident that after printing new highs above the 44.85 or 86 level, the market experienced a sudden 12-point drop before reversing to the upside, but clearly falling short here at testing the session's highs. The market then sells off again goes into another sideways or consolidation phase before taking the sell side out and moving higher once again. Now, this last reversion to the upside gave rise to a double bottom pattern, which, as you already know, is a chart information that typically represents a change in trend and momentum from bearish to bullish. I'd like to point out here, especially for those of you who are new to day trading, that a double bottom pattern is not always a reliable factor to go long because it is subject to false signals and failures like any other chart pattern. In some cases, the formation may not lead to a reversal of the asset's trend and the asset's price may actually continue to decline even after the pattern is formed. Additionally, the success rate of double bottoms and other patterns for that matter may vary depending on the market conditions, prevailing trends, and other factors that can affect the accuracy of the pattern being considered. That's why I think it's important that you exercise caution when relying on chart patterns and use them only in combination with other technical elements before your entries. By confluencing, you can better understand the potential risks and opportunities associated with a particular trade. Speaking of confluences, which is basically a price action trading concept that involves identifying multiple technical levels that align with each other. So based on this concept, I identified this imbalance zone here, which I have highlighted on the chart, as basically an area to place a long order. Now, this decision follows obviously step 4 of my strategy, where the focus was on actually identifying key levels of the market, such as this one, and using them as a bias reinforcement to enter the trade. As you already know, market imbalances are formed when there is a significant difference in the number of buy and sell orders for a particular asset, leading to rather strong price movements that form an imbalance. These imbalances can create unique trading opportunities for day traders to capitalize on short-term price movements. This is because the idea behind imbalances or inefficiencies, it's basically the same concept, is that markets will eventually correct these inefficiency areas and return to previously established levels before continuing the same direction as the initial price movement. So the idea is that by identifying these price action patterns, traders can anticipate potential price corrections and make high probability entries to profit from the market's inefficiencies. Now, my thinking here as far as this particular trading range is concerned is that if the price attempts to balance out the current imbalance zone, it could result in an upward movement. My tendency here is to place a long order at this confluence so that if there is a downward retracement, I can then buy my usual 2 contracts at a lower price, obviously, and hopefully profit if the price rises. In other words, I'm hoping to get a quick fill if there is a modest price reversion. And as you can see from the chart, the market retraced and I was able to get the fill. Then my first profit target was reached as the market initiated an upward movement. This obviously led to price convincingly breaking or pumping through above this descending trend line. Now, descending trend line breakouts obviously indicate a potential shift from a downward to an upward trend. However, and as I mentioned before, there are risks involved in using patterns and in this particular case using this descending trend line strategy. And the reason for that is because false breakouts can occur in terms of you have the price breaking above the trend line only to fall back below it shortly after, leading this way to losses for the trader. Additionally, there may be instances where the breakout is followed by a pullback rather than a continued upward trend, leading to potential losses if the trader does not have a clear exit strategy. That's why, and this is obviously my last step in this trades approach, that's why I keep stressing on this channel's videos that risk management is a critical component, if not the most important of any trading strategy, because it clearly helps us mitigate losses when trades don't go as planned. Therefore, I think it's crucial to have a clear risk management plan in place and adhere to it strictly to maximize green and minimize red. Alright gang, that concludes today's video. If you like the content, please take 2 seconds of your time to leave a like and subscribe. I would really appreciate it. Thank you again for watching, and as always, I look forward to seeing you in the next one.